Hi, my name is Jim and I was retired. This week I'm going to return to one of my most popular topics of the past year and one of my least popular topics. If you look, the most popular videos in the past year have been I bonds, 3 of the top 5. But it's related to one of my least popular topics, inflation. And yesterday we had the latest reading of the Consumer Price Index. So I know my game plan for the coming weeks. This fall, I'm going to redeem my bonds and buy T-bills. Stay tuned. The latest reading of inflation came out on Thursday from the Bureau of Labor Statistics, which releases the Consumer Price Index for Urban Workers, or CPI. And it inched up a little bit in July to 3.2% year over year, up from 3% on a 12-month basis in June. Core CPI, which excludes food and energy, notched down a bit to 4.7% from 4.8% the prior month. Now, the Fed watches another measure of inflation called the Personal Consumption Expenditures, or PCE inflation. That was 3% in June, just like the CPI was in June. And right now it's expected to inch up, just like the CPI did, to 3.23% for July and then 3.58% for August. Now, these readings are largely in line with expectations, but they're still flattening out into the 3%. And so I don't think we can win the war on inflation until they're back down to the 2% official inflation target. But I think the pace that we're seeing means the FOMC, the policymakers within the Fed, are going to leave rates where they are in September and maybe revisit looking at one more final rate hike in November. But for now, I don't see rates going anywhere higher than they are right now. So now is the time to assume that the rates that we have today are what we're going to see for the next few months, and let's go ahead and execute our plans. And for me, that means that starting on September 1st, I'm going to sell the I bonds that I purchased in 2021 and early 2022. Now, to review on I bonds, see my I bond playlist for more, but generally they're a composite rate of a fixed rate for the length of the bond plus an inflation factor that adjusts every 6 months of the life of your bond. Now, these bonds that I purchased in 2021 and early 22 had a fixed rate of 0, and everything was in the inflation factor. And when inflation was high, these were really good investments. But now that inflation has cooled, the 0 fixed rate means it's time to go. I'm waiting until each has passed through the high interest rates and I can surrender 3 months of lower interest rates before I sell them, redeem them. Here's a look at the $10,000 I bonds that we purchased in December 2021 and what they've earned through all of those months. As I've outlined in those prior videos, I'm going to redeem this bond in early September, early in the month, because I won't get anything for September, but I will also only sacrifice the preceding 3 months, June, July, and August. And those are the lower interest rates from the 3 higher interest rate periods that this whole bond is earned. So that's how you decide when to sell your I bonds. And then I have to decide what I'm going to do with the cash. Some of it I will go into current spending, but the rest I'll redeploy into bucket 1 and bucket 2 assets. One option might be to buy another I bond with the current fixed rate of 0.9%. If I buy in September or October, I will earn a composite rate of 4.3%. But then what happens if I wait until November? We have 4 of the 6 months of inflation index numbers using that same consumer price index number that just came out Thursday. So now we have 4 of those numbers that will go into what the new composite rate might be on November 1st. Now there's still several unknowns, 2 more months to go, and anything can happen in those 2 months. Plus, what will the fixed rate be? This future value calculation that I've shown before here to calculate what the rate might be, assuming the current pace of increases, the average monthly increase in that index number has been a little bit over 0.3. So if that were to stay the same, we'd be looking at a pretty good rate, probably comparable to what you're currently getting. But will the fixed rate go up or down? There's a lot of votes on that. Could it fall to 0.5 or could it go up to something north of 1? So a lot is still up in the air. Now here's a look with the other sheet that I've shared before on how interest is earned on your I bonds. And if I went ahead and bought a September I bond, and again, I would cash in an I bond in the beginning of September, and I could go to the end of September before I bought something and still get all of September's interest. And if I did this, and my calculations for that second 6 months are on track with my projections of a slightly higher interest rate for the second 6 months, then the CAGR for after 16 months will be about 4.5%. Well, I could get better returns without the limitations of an I bond on that investment. So is that the place to spend money? I'm not sure. And for now, I'm not going to do this. I'm going to redeem those I bonds, and then I'm going to focus on other parts of my investment portfolio, including the cash-like investments that I have in my tax-deferred account. I'm going to focus on trying to lock in nominal treasury rates for those bucket 1 and 2 assets in the coming weeks and months. I'm going to focus on rolling over the 30, 60, and 90-day T-bills that I have there into 6-month, 12-month, 2, 3, 5, and 7-year treasuries. Now, I'm going to follow the upcoming treasury auctions, and you should pay attention to those as well to make the purchases. And I'm going to choose my battles based on the investments that I need, particularly for bucket 2 investments. That's where I need to focus on making sure that the assets that I will need in 4 to 9 years from 2024 are invested in something that's going to give me a rate of return that is at least equal to inflation, if not a little better. The shorter T-bills and notes will remain in bucket 1, but bucket 2 is going to be for those longer terms. I do not plan to go to 20 and 30-year treasuries anywhere soon. I'm just not comfortable with the rates that they're getting on the treasury yield curve. It's just not rewarding me enough to make those investments. Now, I'm not sure that we're going to see higher rates than today. If the FOMC comes through and raises rates one more time in November, then maybe we'll see another quarter point. Now, I don't think we're going to see that unless we see core inflation eke up past 5% or headline inflation reaching past 4%. And we're going to see a bump around here. It's going to be going up slightly over the next couple months. But unless we hit those thresholds, I'm not sure we're going to see that next rate hike. So this might be the terminal for interest rates for a while. Now, if that's the case, then this is the time to lock in those rates. Hey, please like and subscribe to this channel if you like entertaining ideas from a DIY retiree. Again, I'm not selling courses, I'm not selling you products, I'm sharing my knowledge with you. So please like and subscribe so it goes up on the indexes. I will conclude with my standard warning. I am not a professional planner. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.